It's Frank Capillari from CappThesis. It's a pleasure to be here with you again on Stockcharts TV. So today we're going to go through market update. We'll start with the S&P 500, look at some sectors, commodities, crypto, international, etc. And also we want to touch on an add-on indicator that members have access to that I've been using over the last few months, and I find it to be very helpful and a good complement to my own analysis. So we'll look at that across the various charts as well. So let's start first with the pattern work, because that's the crux of our analysis at CappThesis. So last time we were talking about how we had just seen the S&P hit its first upside target from a bullish pattern when it crossed over 58.40 in the middle of May. And that was very important to see, because having bullish patterns work, or successful bullish patterns, is a key ingredient for any uptrend, especially uptrends that extend further. We talked about how we had 11 consecutive successful bullish patterns in 2023 through 2024, and having to wait now over just about 5 months to get the first one was an exercise in patience, but at the same time, it gave us an indication that things were changing. So now we can look at the other ones that have popped up as well. And so the biggest one at the time when the market was coming back was this cup and handle pattern. Had the breakout in late April, which produced a target of 61.25. And as we know, it was tested a few times early on, and now it has been extended, of course, and getting closer to the 61.25 target. So as that continued, this was an inverse, or is an inverse head and shoulders pattern. Breakout just shy of 5,700 produces a target much higher of 65.55. So we'll keep on talking about this, and both of them really, for that matter, for as long as they are alive with their bullish patterns in play. And so, of course, as the market extends, as it has been, that cushion to come back down to the breakout zone widens, which of course increases the chances of the target actually getting acquired. So along the way, we had this pause here over the last 2 weeks, and as you can probably tell, that also looks like a bullish pattern. Now, if we zoom in here at the 2-hour chart, we can see that this looks like a cup and handle pattern as well. Again, it only comprises a number of days here, but at the same time, you can go back and remember that from the end of April into early May, we had 2 other small bullish patterns break out and also have their upside targets achieved, which of course then laid the groundwork for the 2 other bigger formations that we just talked about to actually take shape and break out as well. So as we can tell, this upside target is near 61.20, which is very close to that first cup and handle pattern of 61.25. So we track all of these, right? Short term, intermediate term, and long term, because of course the best case scenario is you see these formations take shape across various time frames, breakouts occur as well, and of course upside targets then can get hit. So of course, what don't you have when the market's in an uptrend? And that's successful bearish patterns. So bearish patterns typically fail over and over again in uptrends. Again, we saw that it was one of the key reasons why we remained bullish in 2023 and 2024. This is just an indication of what the bearish rising wedge looked like and what the breakdown also appeared as it was happening. Of course, no downside follow through, with the S&P now back through that breakout zone, and this has been completely negated. And we see that even more clearly here, just how impressive it has been for the market to just hang in there, even after a 23% gain, and even after breaking this very steep uptrend line. So of course, that gives us a lot of feedback as well, where you have no downside and follow through even after a big move like that. It just tells us that sellers are not interested in pressing their luck if it doesn't happen right away, like we saw from February to April, of course. So turning to the short-term work, we know the S&P is up about 3.5% from last week's low, which of course is a lot less than what we saw from the beginning stages of this rally when those explosive moves were with us. But compared to what we saw from August all the way really until February, the intermittent gains were about that size, with the rubber band not having to be as stretched, but then adding to the ebb and flow like activity we typically see within an uptrend. And during that time frame, typically you also see the 14-period RSI on the 2-hour chart go between overbought and oversold pretty routinely. And again, that can happen much more quickly when the price action isn't as severe like we had to wait for an overbought reading to occur for a number of months from January all the way until May. And so we can see that now from the downside as well, where the pullback was only about 3.3%. And again, not too different than what we saw during that same period, as we just looked at in terms of gains as well. So one of the things we track a lot are just trading boxes. And anyone who is familiar with Nicholas Darvis, who wrote How I Made $2 Million in the Stock Market from many years ago, but the bottom line is that he was a professional dancer. He was traveling around the world, so he had no access to real price data. So we would look at the price action after it occurred in the business section of the newspaper and started to identify patterns from that. Notice that things traveled in a range or a box, as he liked to point out there, and he would buy as a stock went through that box and then simply set a trailing stop loss. And that worked very well with him during that time when he traded it, because he was involved in a very strong market. So we can apply the same thing to the S&P 500 or really any stock or index that you care about. And as we can tell here, things changed a lot from November all the way to March, where only real identifiable box was this that encompassed multiple months of action compared to what we saw previous to that. So we really had to wait until the market came back to start to identify these boxes or trading ranges and draw these identifiable boundaries around the price action. So what we could have very soon is a potential other box breakout. And as we can tell, we haven't had 3 in a row for quite some time. And this is a very simple concept, but very powerful as well, because if you go back to what happened from 2023, 2024, you could tell that this really captured the trends along the way. And it's especially helpful in uptrending markets which just have low volatility, because you tend to see those pauses. And those pauses then tend to get resolved to the upside. And when they don't, it tells us, number one, there's either a pause in the action or something that is, or maybe a change of character that could lead to an unwind eventually as well. So it leads us to the indicator we were talking about. And so if you go to the add-on section of Stockcharts, you'll find many choices. And the one I wanted to talk about is GoNoGo Charts. And as you can tell here, you don't have to pay for it right away. You can go to their free version, the starter one, and it gives you a good idea of what they have to offer. That's actually where I started and looked at the system for a few weeks. So then all of this is accessible on the advanced charting platforms. If you go to that, you can see this is how it appears. So in very general terms, what this indicator does is tries to identify trend, both when it's strong, weak, weakening, strengthening, and neutral. So as you might imagine, this is a daily chart of the S&P 500, and this is a weekly. When the trend is strong, the indicator is dark blue. When it's strong but not as strong, it's aqua or green here. When there is a neutral or potential transition period, it's an amber or orange. And then the steepest or most bearish trend is dark purple. And then a slightly bearish trend is then light purple. And the indicator itself looks at a host of different factors and compiles all of them together to give us the trend. And of course, it's not going to call every top and every bottom, but what I find it very helpful is checking this anytime I'm looking at the market to understand if we are aligned and if I should be potentially concerned that this is diverging from my own work, or of course, get more confidence if it's showing the same thing. And so as you recall from last time, we're talking about bearish patterns failing, and that happened the third time right in the middle of February. And at the same time, the GoNoGo chart or trend was weakening as well. And so of course that really stayed with that trend all the way to the bottom. And so after a few weeks of rallying action, it turned to go as well. And so recently, as the market has started to break out from those patterns, it's been in a bullish trend. Now, from a weekly perspective, it of course was negative as well, now in transition and starting to go into a positive trend as well from a more longer term perspective. Now, some people will say, well, that's way too late. Well, from a weekly perspective, we need a lot of things to change, moving averages to start turning higher, so forth and so on. But I will point to the other times here in 2022 and then coming out of COVID, where it took a number of weeks for that trend to change as well. But this happened right in March 2023, that's when we started to see bullish patterns starting to work. And then also, if you go back to COVID, this was a few months after, but it got positive right before making new highs. And the most important thing is when the weekly GoNoGo trend indicator starts to change, it typically leads to a lot more positive action in the weeks and even months to follow. So it's a good one to look at and complement your own analysis no matter what you're doing. Okay, turning to crypto, as we can see here, Bitcoin has been coming off its highs. And one of the things we have to be mindful of is that we know that when the trend changes in crypto, it changes pretty quickly. So right now it's below this pretty steep uptrend line. Now we knew at some point that was going to occur. Really a matter of now of what it does in response to that. And one of the things we're looking at very closely is the RSI. And one of the reasons is this, as we can tell, going back to late 2024, we can identify three key trends, right? Up, down, and up. And when these trend lines were broken in both to the downside and upside, that's when momentum started to shift pretty noticeably. And as we can tell, the 14-day RSI, when the trend is strong, of course, stays in between the neutral zone and also overbought territory. So it's getting very close to testing that 50 area. So it's being important to hold there, because when that didn't happen back in late December 2024, just a few months ago, that's when things started to change once more. Now, Bitcoin did rally back up to new highs, but what didn't happen, didn't get overbought at that time. And then things started to unravel, of course, until April. And that's when the RSI, for the most part, stayed below the 50 zone. And so for this to continue and stay near its highs, really feel that momentum needs to stick with us as well, because seeing this then fall below this 50 zone really will signal to traders that maybe this most recent move is over with. So it's going to be important to watch going forward. As we talked about last time, Bitcoin was topped a few weeks before the S&P 500 did. So if nothing else, it's a very good indication of trend for risky assets in general. Now, from a weekly perspective, it's important to hold because this right shoulder, this potential very substantial multi-month bullish formation or inverse head and shoulders pattern remains in play. And it looks very similar to what we saw in 2024 as well, where the right shoulder was a little higher and shorter than the left one both times too, which shows that buyers have been willing to support this at higher prices this time. So again, holding near 100, keeping that short-term RSI above 50 will be integral for this potential breakout to occur, which would have an upside target above 140,000. And also, we want to see on a weekly basis, again, this RSI get back up to overbought. And it got close to doing so during the most recent push to new highs, but without the Bitcoin getting through 110, emphatically, it's prevented that RSI from getting too overbought. And overbought for Bitcoin, both on a daily perspective and weekly, is of course the most bullish thing we can see. So in terms of Ethereum, the good thing is that it's held near its highs better than Bitcoin has, most recent highs, but still waiting for this breakout to occur. We're going on a number of weeks with this right shoulder kind of extending longer and longer. But as we can tell here, this is a pretty substantial potential bullish pattern as well, where the breakout would get us a measure move to nearly 4,000. And so we're watching this RSI again closely. The good thing is that it's still above 50, diverging slightly with price right now. It's not too bad because Ethereum continues to hold in there. So eventually maybe this comes back up to overbought territory as we get the breakout. So again, we can go back to GoNoGo, right, and see what both of these look like. Bitcoin, as we can tell, has been in a bullish trend on the daily, since the breakout occurred a few months back in April. And it's been in a bullish mode from a weekly basis, going all the way back to the beginning stages of the rally in 2023. So strong trend there from both a daily and weekly perspective. I'm excited to introduce CapNotes, our free Substack newsletter, where we provide timely market commentary, trade ideas, and access to select premium content. Sign up today and receive our 6-step trading process that powers winning chart trades and limits losses. This is a simple, proven framework for spotting high probability setups. Simply go to capnotes.substack.com, hit subscribe, and we'll send that guide directly to your inbox. And so now we're turning to international. So EWP is the Spain ETF. As we know, all of these foreign ETFs are priced in US dollars, so it obviously helps when a dollar goes down, and it's helped Spain in a major way. We know that it's been one of the major leaders for the year, both in Europe and the world, because of the fact that the ordinary indices are moving higher along with the dollar moving lower, to the point where this is a log scale. And we can see that even now it's been coming back for a long time from the 2022 low, but along the way it's kind of gone through this back and forth movement within this trading channel until the last few weeks when it exploded through there. So pretty extended, no matter how we look at it from a daily perspective or weekly. And if we just have a little uptick in the dollar, this could come off a bit. So I would advise against chasing it on a short term, but let's zoom this out a little bit and look at what this has done on a monthly basis. Again, log scale, moving all the way back to the beginning of 2000, where we've had numerous very strong runs along the way, over 100% for months at a time. So from this perspective, it's getting close to levels which we saw EWP eventually roll over. What's also noticeable here is that it's overbought on a monthly basis for the first time since it completely rolled over in late 2007, early 2008. So that gives us pause, but at the same time, when we talk about things being overbought, we have to look at the first time that happened. So the first time that EWP got overbought on its way higher was in 2004. So in the middle of this massive rally, and still had another few years left, right? And so let's not just discount this as something that completely needs to roll over. It may just need a pause if this is going to replicate anything like we saw back 20 years ago. This is still the silver miners ETF, and it's just been a series of breakouts along the way. We've looked at this from various angles. And one of the things we tell our clients is that the best case scenario, as we know, is seeing bullish patterns take place across various timeframes simultaneously. And so still right now, very close to hitting our first target of 47 on this daily chart. And if we then zoom out to the weekly, we can see that whole zone here, this green, was that bullish pattern, which is then part of two other bullish patterns. This is a log chart, so this is a double bottom, which is, we finally saw some follow through after some back and forth movement here. That has a target near 49. As we can tell, there's an even bigger pattern in green taking place too. And before we go to that chart, going back to the RSI, we can see how this oscillated between overbought and neutral for quite a long time as the market was coming back and forming these other patterns. So from a monthly basis, we can tell there's an even bigger potential bullish pattern in play. This double bottom formation, which is taking place going back all the way to 2013. So that green pattern in the previous chart is right here. And as we can tell, that targets around 74. And that is part of an even bigger pattern going back to 2013. There's potential double bottom formation. Now, we wouldn't have wanted to stick around and wait for this to occur. It would have been a huge opportunity cost. But along the way, we can tell when you have all these bullish patterns in play at the same time, this gives us confidence that the trend is obviously on our side. So again, going back to looking at SIL on GoNoGo, no surprises. We've been in an uptrend for, going back to almost the middle of 2024 on a weekly basis, and on a daily, a little bit more jagged action as it's found its way, but as the breakouts have been occurring, started to get back into a bullish trend from there as well. Sticking with commodities, this is USO, the oil ETF, and it's been a struggle recently with crude oil trying to find its way, but over the last week or so, we see the beginning stages of the right shoulder started to build, finally got a breakout marginally so over the last few days, and that has a target up near where it's failed before, so high 70s. So that will be an important step to get back to for eventually seeing USO turn in a more substantial manner. And of course, if you zoom all the way back, going back to 2014, we know this has been a much longer and tight trading range to eventually get through. And we know that's coming back from the COVID lows is still taking its time along the way. But this is why so many people remain bullish on energy, because you see these potentially long trading ranges along the way. And if we look at this on a log scale, right, it's just been a decline all the way since 2008, where talking about Darvas boxes, right, downside break over years, second one downside break when COVID happened, and now again trying to consolidate after the comeback. So this could be one big continuation pattern on the upside. So let's see what it looks like from GoNoGo, both daily and weekly. Not as good yet, right? Still need a lot more confirmation. And that's because we've seen so many times this fail. So eventually, if you get back up and get closer to that target, we'll see this change from bearish to neutral to bullish. And we'll need a lot more to go on the weekly as well here. Something to keep in mind as we go forward. And so looking at some sectors, one of the ones that we've been looking at recently is XLP consumer staples, because this one just hasn't broken out yet. Now it's come close, it's teasing us a little bit here with a breakout zone, but if it does, we can tell it would target higher prices. It would give us a new high to 87 on a measured move basis. And it's even more important to realize that on a monthly basis, we've seen twice now XLP dip below the previous breakout zone to new all-time highs, and twice we've seen strong monthly reversals. And so again, now back above the breakout zone, now close to confirming that breakout potential on a daily basis, and if it does, again, much higher. So XLP recently back to a bullish trend. We've seen it before. We need to see a better effort this time, but on a weekly basis, right, it's actually in a bullish trend before the S&P is, because it didn't get hurt as much on the way down. So that's obviously a positive too. So looking at the XLY versus XLP ETF or ratio, it's helpful because, as we know, XLY is consumer discretionary. So when that gets stretched, it just means that obviously consumer discretionary has been doing much better than XLP. And looking at a daily chart, that happened once more. Just a few weeks ago, it hit overbought for the first time in a number of months. And these are all the other times on a daily basis when XLY was overbought versus XLP. And as you can tell, most of the time that ratio started to roll over, and most of the time as well that eventually got back to oversold. So this is already off of its highs, but still above 50 on RSI basis. So we think that there is a chance that that continues to unwind more, with maybe some rotation going in to consumer staples. So in terms of XLV, which is healthcare, as we know, it's been a clear underperformer for months. And we can see that by the weekly moving averages have completely rolled over as well. So the question is there any indication that this is going to potentially rally and have a mean reverting move? Well, if that's the case, we want to see support. So we can't really see support that well from this angle. But if we zoom out to the monthly, we can see that there's two lines here that make it come into play. One is the uptrend line that starts at the great financial crisis low, extends to basically hitting the COVID low, and now where it is once more. And that is very close to support that we saw from 2021, 22, and 23. So this area is kind of a confluence of support lines from a monthly basis. So if there is an indication that is going to at least find some sort of bounce, it would happen around here. And also, we're coming off a month when XLV underperformed the S&P 500 by 11%, which is the worst performance discrepancy versus the S&P 500 since the XLV's inception in 1998. So putting all that together, you would think if there is a time for the ETF to actually find some capital flowing maybe from some other areas that are extended, this would be the month for that to occur. So lastly, once more, let's go to GoNoGo, take a look at how that looks. Probably not too much. Definitely not. Need to see much more than just a bounce from an uptrend for this to change, but this will be something we'll be looking at in the weeks and months to come. That's it for now. Talk to you again soon.